How to analyze real estate cash flow. Have you ever wondered how to effectively analyze cash flow in real estate? Understanding this concept is essential for anyone looking to invest wisely and build wealth. Let's break it down step by step. First, you need to calculate the net income a property generates after all expenses are paid. This will help you determine if your investment is profitable. The basic formula is simple. Cash flow equals total rental income minus total operating expenses. Operating expenses include mortgage payments, property taxes, insurance, maintenance, management fees, vacancy costs, and repair costs. If your cash flow is positive, it means your property generates more income than expenses, indicating profitability. On the other hand, negative cash flow means your expenses exceed your income, which could signal a potential loss. To analyze cash flow in detail, start with projecting effective gross income, often referred to as EGI. Begin with the total potential rental income, then subtract expected vacancy and collection losses. This will give you the effective income you realistically expect to receive. Next, identify your gross expenses. Make a list of all operating expenses, including property taxes, insurance, maintenance, utilities, legal and administrative costs, and debt service, which includes both loan principal and interest payments. Now, calculate your net operating income, commonly known as N. This is done by subtracting operating expenses, excluding debt service, from your effective gross income. The N shows the property's profitability before financing costs. After that, calculate cash flow before tax. This is done by subtracting debt service from N. This figure shows the actual cash available to you before income taxes are taken into account. Consider calculating cash-on-cash return next. This ratio compares your annual before-tax cash flow to the total cash you have invested, expressed as a percentage. It helps you evaluate the return on your actual cash investment. You can also use additional metrics. The capitalization rate, often called the cap rate, helps you compare operational profitability among properties. This is calculated by dividing the N by the property's market value. Discounted cash flow analysis can be used to value the property by projecting future cash flows and discounting them to present value based on a required rate of return. For Asian American real estate investors, understanding and analyzing cash flow is vital for building wealth and making informed investment decisions. Many focus on maximizing cash flow by increasing rental income through property improvements or strategic leasing, while controlling expenses through efficient property management. Analyzing cash flow carefully helps in selecting properties in markets with stable demand and growth potential. This aligns with long-term wealth-building goals in real estate investment. Practical applications include using cash flow analysis to compare multiple investment properties objectively. You can project future cash flows to assess long-term investment viability. Evaluating financing options can optimize debt service costs and improve cash flow. Lastly, monitoring cash flow regularly after purchase ensures your investment remains profitable. In essence, analyzing real estate cash flow requires a clear understanding of income and expenses, careful calculation of net income after all costs, and applying this knowledge to make strategic investment decisions that fit your financial goals and risk tolerance.